Can you pay the high deductible health insurance premiums from the HSA?
So a lot of different opinions on this one. I see it. I've seen commentary both ways. I think it may depend on the type of premiums. I know there's some you can, certainly your Medicares and things like that. I think it's B and D and Medicare Advantage. I'm not so sure, Toby, if you know exactly about the high deductible plan and premiums, whether or not that can be or not.
Yeah, you can pay any deductible, anything that's out of your pocket. You can absolutely pay it
Very good.
out of an HSA. And the reason you do this, an HSA, triple threat. If it's a high deductible plan, which means if you're single, the deductible is $1,500 or higher, and there's a maximum out of pocket. I think it's around $8,000. If it's a family plan, I think what are you, 3,000 maximum deductible, and what is it?
15.
15. So there's some simple rules, and most insurance companies are going to make sure you fit within that rule. Now, here's the thing: you get a deduction if you put money into an HSA. I think it's what, 7,500 this year. Do you know the exact amount?
I don't, but it's in that ballpark.
For a family, it's high. For you, it might be 3,750, something like that. You would just look at HSA amounts, but it's deductible to you. So I get a personal deduction, just like an IRA. I can fund my HSA. I think I have until April 15th, but you want that plan in place. And now, if I write and use that plan to reimburse myself, ordinarily, I would have to exceed 7.5% of my adjusted gross income, and I would have to itemize deductions in order to actually get a benefit for my medical expenses. By doing an HSA, I get to write it off right away, and then it can reimburse me. It doesn't have to reimburse me before the end of the year either. It can reimburse me at any time. As long as I have an HSA in place, I could reimburse myself. Let's say I had an HSA in place last year. I could reimburse myself out of that HSA for last year at any time. But I get a deduction for putting it in the HSA. The HSA, as it grows, and I could just, I could trade it myself. I could do a self-directed HSA and do other things. But as it grows, there's no tax. And then as long as I use it for health coverage, health expenses, including my deductibles or copays, I don't have to pay tax on that. So that's what we call a triple threat. And there's very, I don't know of any others that are like this. I get a deduction going in, I get tax-free growth, and I do not have to pay tax on any of it in the future. So let's say you're single and you put $2,000 in an HSA. You're like, Toby, what's the benefit of it? Let's say you're in the 24% tax bracket plus your state. So maybe you're looking at 27% or 30%, just make the math easy. You would get a $600 tax benefit. And then I use that $2,000 to pay the deductible. I just got a $600 benefit. I just got 30% off or whatever it is, right? That's all you have to do. And you can set up an HSA for free. You go to Fidelity or any of these major brokerages. I have one at Fidelity. And I traded like crazy. I had a huge return in 1 year. I thought I was a genius, right? And I'm just sitting here, and what could I use that? At any time that plan is active, I can reimburse any of my medical expenses. So I'm not doing it because I'm letting it grow, but it's getting bigger and bigger and bigger every year, the amount that I could spend. So it ends up being great. And people are worried about somehow they're going to have to pay the, I'm going to have to pay tax on it if I have money left over. Yeah, you're not going to have money left over if you use it, unless you just blow it, and then that's at least your problems. You'll probably end up paying tax on it. I think if you get over a certain age, like 65, there's no penalty. You just pay the tax if you take it out for any other reasons than health. But for the most part, if we're using it on health expenses, and we all have them, you never pay tax ever on the contribution or the growth on it or the withdrawal. Triple threat. Pretty beastie.
Absolutely. And just a little bit more, a real popular question we've had in the last 2 weeks is, a lot of our clients have maybe a C corporation with a medical reimbursement plan 105. We get asked a lot, can you use them both? And typically, if you do have both of those going on, the code will basically say that you do have to spend up to the deductible amount first, and then you can start using your 105 plan. Alternatively, you could have your 105 plan, what we call limited, where maybe it can only be used for things such as vision or dental, things that typically wouldn't be used under the HSA. And so those are two ways that you could use both of those plans.
All right, I just used the internet and it's so omnipotent. The self-only amount is $38.50. That's how much you can contribute individually, and as a family, it's $7,750. So
Nice.
that's the max Amy was asking. You have now received. That's for 2023, and it is indexed for inflation. So we like that one. We're going to have to do some. Thank you, Congress, for doing something
Right.
not being turds. So you get the non-turd award, Congress, for doing that one. All right, next question, which is hard for them. It probably was like,
They've probably spent hours.
What are we doing this for? And add an extra $1,000. Yes, if you're over, I think it's 50, you get to add an extra catch-up of $1,000. So you're over 50?
Yes, I am. I'm
Damn, and you
I'm
old?
AARP or
You
whatever.
old.
I am.
I am too. Not gonna. Yeah, I'm okay with that. Patty's way over 50.
I was glad I made it.
Oh
so
my
far.
gosh, Patty says I'm older.
If you like this clip of Tax Tuesday, then I invite you to join the actual show. It's every other week, and you can ask your questions and get them answered live by myself and my team. Just click the link.